One of the big knock-on effects from what's happening geopolitically at the moment is interest in gold. In the next 15 minutes, we'll be taking a look at gold in the context of what's happening geopolitically. Gold as a hedge against some of the rise in the fear index that we've seen. Also, what's happening with gold in terms of some of the other currencies, and of course also with inflation-adjusted numbers as well. Let's take a look now in some more detail with our guest for the next 20 minutes. It's Ron William from RW Advisory. Ron, welcome. It's good to be able to catch up with you. The title for this, and I know the title you've used, In Gold We Trust, of course, that is a play on what we see on US coins in the States. It goes back, I know, hundreds of years, but in terms of where we are with gold, how important is this as an asset class at the moment?
Very important, front and center. Global investors will be seeking sources of both trust and capital protection in this VUCA regime. Remember, that's volatility, uncertainty, complexity, and ambiguity. And essentially, VUCA amidst dynamic market forces, escalating geopolitical risk, as you just mentioned, and ongoing inflation. So these are all factors that are driving gold higher, and really key feature of our discussion today.
Okay, let's take a look at how gold is, as in your words, say it's shining over other cross assets.
Yes, well, this is the primary model that we use at RWA, looking at best and worst performers across multiple cycle horizons, strategic, tactical, and active. You can see there figure 2, giving the educational framework, and 3, giving the actual performance over time. And you can see the big jump up in that line favoring gold from February onwards after the geopolitical shock that took place vis-a-vis Russia, Ukraine. Now, the story here is inflation, ultimately, with rising US 10-year yields up 80 basis points year to date, commodity boom extending with oil now 110 and change dollars, up I think approximately $50 year to date. So some big movers both in terms of rates and commodities, specifically oil. And this is, of course, accentuated with the geopolitical risk, but not limited by it. And ultimately, the rest of what you see here in terms of the other colors on the screen show relative underperformance as part of a Q1 tactical risk-off phase. So, of course, we did start the year with the worst January performance since the global financial crisis of 2008. And that's what you see here. Many of the markets falling in this quicksand situation, whereas the capital preservation markets, inflation and crisis hedges are still holding strong.
What about the technical analysis around the gold chart at the moment? I know we've spoken about this before in the symmetrical triangle, the breakout from that, but of course, as we see the markets move higher, we're getting to some more interesting technical levels. What would you say to anybody that uses technicals to trade gold?
Yeah, so be aware of breakout patterns. They are certainly the most attractive and sexiest technical setups where we can make good money quickly. But as I've dubbed this chart, the Bermuda Triangle, it's a sideways, volatile environment that gold has been in for the last year or so, very unloved just because of the lackluster performance during that time, but also due to the number of false signals that have taken place. Just look at the choppiness of the gold market throughout the moving averages there. I put on the tactical 50-day and strategic 200-day. And so the reason why I'm beginning with that word of caution is because a lot of people would have already traded the upside breakout. That's good. People making money on a clear signal. But do know that the better and more consistent signal will be above $19.20. That will be key. That's a line in the sand on the gold market. And we do need to sustain a break. We've already had an intraday break and then failure reversal on that area. Wait for a confirmed price and time confirmation above 1920, maybe on a weekly or monthly time frame for more strategic confirmation of the upside risks ahead. One last thing I'll say is there is, on the risk side for this gold up move, the 200-day moving average remains key at $18.10.
Talking there about some of the short-term technicals, what about the long-term technicals to consider? Are we in a long-term pattern that we can follow?
Yes, absolutely. And that old market adage, the trend is your friend, remains very true for gold. We've discussed this before about a year ago, Jeremy, when gold held above its strategic 200 moving average on multiple times, even through the pandemic of 2020. There was an intermittent breakdown, but it rallied back higher. And as we can see here, 20 years of upside. And if on the far right side of the chart, you can see another price pattern. This time it's a base pattern. The bigger the base, which is basically accumulation in the market, the bigger or the higher in space is another adage. And so the original target, which was successfully predicted, was 2070, the prior peak level on gold, but the higher next target is 2,400 on this chart, and that is part of the base pattern extension work that you see there on the slide. If you look at the lower part of the slide, this shows the impulsive nature of gold's move. So that green line actually measures the number of monthly consecutive up moves in gold. The average is 4 months. That's what happens when gold is doing a normal move. 4 months up, 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 and up again. But actually the record is 10 months. So if gold really wants to scream higher, it can. And this is really just the start.
That 2,400 target, of course, would take us above the unadjusted record high of gold that we saw back in August 2020. What about the adjusted inflation price of gold? Because one doesn't often consider the long-term picture with gold in sort of relative moves compared to historical inflation-adjusted gold prices.
Well, this is where the big picture historical view really matters, both in terms of price projections, certainly adjusted for inflation when we're looking at gold, but also with an understanding of the historical rhyme of how markets behave. And so here we can see the infamous gold spike in 1980 that most people will recall from the archive records, up $700 in just 1 week, which is something to really think about. Gold doesn't have to do the same thing. Again, history doesn't have to repeat, but certainly the rhyme would be a spike where we could get a big move quickly, which is good for people who want to go long gold, but actually because it's a spike, you'd also need to have very good risk management and due diligence, because you need to get in and then get out in that volatile situation. So that's just a tactical point of view there for people who want to factor that in. The second part of this is why gold spikes in history. And the answer is crisis hedge, both for geopolitical risk, but also for various inflationary or even stagflationary environments. And you can see that 1980 was actually the geopolitical event of the Soviet Afghanistan incursion, Iranian Revolution, and the economic background was double-digit high inflation. 1974, which is the baby spike on that chart, but still important in terms of rate of change, and the event factors, that was the Yom Kippur Arab-Israeli war and a stagflationary environment. So a few geopolitical experts are already making allusions to these risk or worst case scenarios should things escalate. Right now, of course, we're getting a little bit of a calm after the storm post sanctions. And so best case, things stabilize and maybe peace talks follow. Risk or worst case, these are the historical rhymes to keep in mind, and what happens to gold if and when that happens.
Of course, as we know, because gold is priced in dollars, there is, as your chart just showed, that the nominal price, there's the inflation price, but there's also an adjusted figure, isn't there, for individual currencies? And that's an interesting thing as well, because if in a local currency you're buying gold, you are actually buying gold at very different levels.
Yes, and certainly this is something that, I mean, both the IG audience and many of my clients will speak of on a regular basis, because it really depends on which country you're in and how you see the gold market in your local currency. Also interesting to look at it in terms of a broad recognition of the rising tide in gold. A lot of investors were looking at the lackluster performance of gold priced in dollars, but look at other major currencies. So I've got on the left side there a basket of currencies. The leaders are gold versus euro, Australian dollar, and Swiss franc. And if you just see on the mosaic on the right, it actually shows you the classic technical charts. And gold and euro is already at a new peak breakout above the prior peak highs. And then the last point I'll make is the major FX currencies also strong. Some of the supply and demand proxies as well in terms of Australia dollar and South Africa. But most importantly to what's happening geopolitically, which is on the bottom right-hand corner, gold and Russian ruble is naturally moving up in a straight line as part of this crisis and debasement effect following the events of what's happened. That's also transpired not just in gold, but also in Bitcoin. Record transition from Russian investors into some of those crisis hedges.
You talk there against the Russian ruble, and of course the geopolitics is to some degree an unmeasurable force here. Clearly, we've got a benefit for gold because of the geopolitics. What about measuring gold against some of the other market forces, if you like, some of the more measurable events that are going on, such as the potential for rising interest rates?
Well, this should really be a headwind for gold, which traditionally has a negative correlation with real yields. That has actually switched from negative to positive and hit a record extreme. If you can just see the breakdown on the left, figure 1, the record positive correlation, figure 2, and that is partly because of a greater emphasis to hedging geopolitical risks vis-a-vis gold, inflation concerns, certainly over the long term, if we factor in some of the commodity moves that we've seen, and then broader market uncertainties, which continue to be here. Interesting point that investors did actually add a significant amount of gold in January, according to World Gold Council data. The figures I have here are net flows into global exchange traded funds were positive to the tune of 46.3 tons. US funds added 49 tons, whereas Asia had a little bit of exit in that market, but certainly strong fund flow. And you can see that the positive blip on the chart there in figure 3. And essentially, this is all overriding some of the interest rate related headwind. But the caveat to all of this is Fed policy, whether they allow for further inflation going forward or a more hawkish stance. Watch out for the March FOMC meeting as an example.
Let's move on now to your next chart, because you talk about an equilibrium level in the price of gold. Let me ask you about that and what it means and how we should interpret this.
Yes, well, a key part of our approach at RWA is something we call blended triad approach, which is macro, fundamental, and technical. And so if we just look at the fundamental side, this is a valuation model developed by Charlie Morris, ByteTree CIO, where he treats gold as zero coupon, 20-year US Treasury inflation protected security. This is all based on 3 key factors: the historic debasement, present value, and outlook. And essentially what the chart shows is that we were undervalued according to these factors late last year, 2021, but we're now switching into the historic normal territory, the equilibrium level at a plus 20% premium. We could overshoot to 40%, so we could actually go much further higher. But in current levels, this is normal valuation measures, and certainly gold can hold here for a while longer, if not push higher. It's a great contrast also to the lackluster performance that we saw last year and how things are now changing.
Interesting you talk about a zero coupon for gold. Clearly, it doesn't actually return the thing. You are right. And any benefit we see in the market is obviously appreciation in the base value of the metal. I just want to follow up, if I can, on one final aspect of this market, is how we go about this process of preserving capital in these times of economic, financial, and geopolitical stress. It's all about, isn't it, us being able to preserve our current capital situation. How do we do this, given the current context of the conversation?
Well, great theme that you highlight there about capital preservation and just trust in what works best for the portfolio. And we have switched from wealth creation to capital preservation. Certainly, the start this year was a wake-up call to that change with the market regime shift, the elevated volatility, and now, of course, geopolitical risk. And so what this chart highlights is the new recommendation for being bold and brave. And I'm borrowing the term also developed by Charlie Morris at ByteTree, where he talks about owning a diversified play between Bitcoin and gold, a structural bias to gold. Think of it as an 80-20 setup. And this is based on a volatility weighted index and ultimately shows how it can be a long-term store of value. The trend has been up over the last few years. And what's very interesting there is you can see the overlays I've added to the chart at the bottom, highlighting the risk on, risk off rotations, which we can actually position for across the board. We don't have to choose between the two. So if you can look at the far left, and I can walk you through quickly. Remember the 2017 top in Bitcoin and the 70% crash that then followed. Owning gold during that time would have clearly supported your portfolio. And then if you follow on from 2019 to 2020, gold actually stormed ahead with an 80% appreciation in value. So clearly a good reason to have a structural bias to the yellow metal for that capital preservation. And then what followed in 2021, Bitcoin clearly stole the thunder again with 135% gains, which would have not only outperformed, but would have really made a difference, even if you had a small allocation. Question mark is right now, after the shakeout from Bitcoin and this new breakout to the upside in gold, what does the new regime hold ahead? And the simple point is own both with a structural bias to gold as an ultimate diversifier for the period ahead.
Ron, look, it's a pleasure to be able to catch up with you again. We've got to leave it there, but thank you so much indeed for your charts and your insight into this idea that we should be looking at ways in which we can continue to preserve capital. That's Ron William on the line there from Hong Kong, from RW Advisory. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.